Hello everyone, my name is John Locke and I'd like to welcome you to the winning trade, but first the required disclaimer material. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors. We're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also, keep in mind that the trades in this presentation are hypothetical computer simulated trades and/or results. They would be believed to be as accurately represented as possible. Keep in mind the live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance and financial freedom and success coach with Locking Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of high probability options trading. High probability options trading, also known as income trading or positive theta trading, is where we utilize option strategies to make money in the marketplace through the passage of time rather than depending on price movement in order to make money. Now, this doesn't mean we're going to make money all the time, but it does mean that we can often be profitable whether the market goes up, down, or sideways, which is extremely beneficial in this sideways and downtrending marketplace. And the strategy that I'd like to share with you today is a strategy called the Bearish Butterfly. Now, the Bearish Butterfly is a strategy that I started or developed in approximately 2007. And we've been trading this strategy, or I've been trading this strategy, and a lot of my students have been trading this strategy live for many, many years. I believe it's about 15 years or so now. And it's been a very powerful, time-tested strategy that I really love, and I'm excited to share with you today. So what we do here is we trade a butterfly on the Russell 2000 index, and the strategy itself is designed to take advantage of a variety of market movements, such as sideways trending markets, volatile downtrending markets, and in general downtrending markets. And you'll see that it generally does very well in this type of market condition that we've been experiencing recently. The trade itself requires a minimum of $5,000 per trade. We're going to show you an example size of $50,000, what we call planned capital. It doesn't mean we're going to get that much in the trade, but we are aware that we may use as much as $50,000 in capital. We're going to have a profit target of 30% of that planned capital, which is in this case going to be $15,000. We also have something called a reduced profit target number. Generally, if this trade goes well in the beginning, we can come out and we get a higher number of like a 30% profit. If it does poorly, or the market's extremely choppy, or goes to its extremes, then we tend to get close to expiration. And when we get close to expiration, we more or less like to be out of the trade. The gamma gets a little bit high, so we reduce our profit target to $5,000 or 10% of our planned capital. And our exit loss trigger, should things go poorly, is 30% of our planned capital, which is going to be $15,000 in this case. So let's take a look at the trade and the conditions, and we'll give you a great example here. Okay, so before we get going, this is a software called OptionNet Explorer. It can be found at optionnetexplorer.com. And what it does is it gives us a picture of basically what we have. It also allows us to go back in time. So it's really great for giving examples. It's good for back testing if you like to back test. So what we have here is we have our analytical chart. We have the asset price across the bottom. We have our profit and loss up and down the right side. So it's a little different than the price chart. We have the sharp edge line, which is our expiration graph. Gives us an example of what the position value would be worth at expiration should we let the options expire and settle at any given price point in the Russell. And it gives us a T+0 line, which shows us our risk of price movement as of today. And again, this is a theoretical line, and it does move up and down a little bit, so you can't take that at face value all the time, but it gives us a general idea of what's going on in the position. If we look over here, these are our option strikes. We are trading in the October 2022 expiration cycle that expires on the 21st. We are back in time here to August 26, 2022. This trade starts 56 days to expiration. That's what this 56 number is. It tells us that the options expiration date is 56 days into the future. And we have our calls at the top, we have our puts at the bottom, we have our strike levels in here. For those of you who haven't seen this software, this is our profit and loss number down here. With entry, we do have some entry costs, we have execution costs and so forth. So that is down $40 on entry. Our current margin is $4,590, which can also be seen at the bottom of our expiration graph here with our P&L. And this is our delta number, and that's a number that we tend to watch on a lot of the more non-subjective strategies, and that gives us an idea of what our price movement risk or our profit and loss risk is with $1 of price movement in the asset. So a minus 10.5 implies that if the asset price goes up $1 or $1, then we're going to lose $10.50. If it goes down $1, we're going to gain $10.50. Again, that's a theoretical model, doesn't necessarily hold true. And then, of course, we have a number that we watch a lot as income traders, and that is our theta number. That's 40.08, which implies that every day that passes here, or for the next day, I should say, this is only valid for the next day out. But in the next day, this implies that if nothing else changes, in other words, our implied volatility doesn't change, our asset price doesn't change, then we're going to gain $40.08 over the period of a day. Again, that is just theoretical and doesn't necessarily mean that's going to happen. Sometimes you can go a few days without price movement and lose money. Sometimes you can get a lot of price movement and you can gain a lot of money. But it is a reference number that we use from time to time. So that is the position here, and the way we're going to enter the market is we have an asset price, which is right here. This is the last asset price. We actually check at what we call 15:30 Eastern Time, which is going to be half an hour before market close. Well, in any time frame, but 3:30 in Eastern Time. And we have our calls here. What we're going to do is we're going to take a look at the asset price here at our checkpoint time. We call this the checkpoint time. And it's 19:02. We're going to go about 20 points under the money here. And that is going to be 1880. We're going to sell our short strikes, calls and puts at 1880. We're going to buy 50-point wings here. So we're going to buy 10 1930s, 10 1830s. We will want to do this in one order. We don't want to try and leg into it. We don't want to do one option at a time. We want to have a broker that actually does butterfly orders. And that's what this order is called. This is what it looks like on our analytical graph. So from here, what we're looking for is the price to move, which it usually does. If we start to get positive delta in this position, and the positive delta number, the exact number varies depending on if we're 1/3 scaled in, 2/3 scaled in, or 3/3 scaled in, and we'll explain that in a minute. And when we reach positive delta, we're either going to scale out or we're going to roll this back. And if the asset price goes up, we do what we call scale in. This is a 3-tranche scale in trade, meaning that if the asset price goes up, we're going to increase our size by 10 contracts. If it goes up even more, we're going to increase our size by another 10 contracts. So we're going to have up to 30 butterflies in the position. If it continues to go up, we have a rolling process that comes into play where we take the lower butterfly and we move it further forward so that we can stay up with the marketplace. In general, the trade mostly maintains negative delta. That's why we call it a bearish position, bearish butterfly, because it's more appropriate for more sideways or bearish markets, kind of like what we're in recently. So here is what our entry position is going to look like. And what I'm going to do is I'm just going to go from adjustment to adjustment, and we'll see how this goes. This is a great example, by the way, because it has multiple rollbacks. It has a full scale in, and I just really like this for an example of the strategy. It shows it quite nicely. And by the way, this is one of the 12 strategies that we cover non-subjectively within our Go membership level at lockinyoursuccess.com. So I encourage you to go over there to lockinyoursuccess.com, check out our membership levels, and to see continuous coverage of this strategy through all market environments in a non-subjective manner. That's where you can find that. We are the only company who does such a thing with their trading strategies. And it's an excellent, excellent way to learn and understand how to become an awesome trader. So let's get going here. And I'm just going to jump to the first adjustment. So it's Friday, August 26th. And just as a reference point, let's take a look at our chart. We just came off a very large up move here, and we're starting to pull back a little bit. And we had a pullback here, testing a support level more or less at the 1900 area in the Russell. So let's go to first adjustment. And it happens on September 1st. So if we take a look at what happened here, remember the asset price was up here at around 1900 when we entered, and we've dropped about 100 points. We're all the way down to 1812 here. And what happened is we are positive 5 delta. So what we do in this position when we have a down move and we're 1/3 entered is we want to get the delta back to neutral. It might be a little bit positive, a little bit negative, but as close as we can to neutral. So we're going to basically close this position. We're just going to close the butterfly down, and we're going to go into our modeling software, and we're going to see what butterfly strikes are going to produce a neutral delta in the position. So in this case here, if we sell our 1880 butterflies and we go down to the strike level of 1860, we are 0.81 delta. That's relatively neutral. And this is going to be our new position. So we sold the 1880s, we roll back to 1860, and this is what we look like. So let's see what happens here from here. So it's September 1st. We stay in this position until September 16th. And what happened in the market is we had a bit of a bounce in the marketplace, and not high enough to get us scaled in, right? Because remember we said when the market bounces, we scale the position in. It wasn't high enough to get us scaled in, and then the market came back down here again and is testing this swing low here. And again, we're getting 2 positive delta in this position after this 38-point down move. So what we're going to do is we're going to do the same thing. We're going to close this position out. We're just going to sell that butterfly off. And we're going to buy at a level that produces a relatively neutral delta for us. So in this case here, we sell the 1860s, and we come all the way down to 1820. And at 1820, we're at 1.72 delta, which is fairly neutral. Again, we could take a look at the 1810 strikes, and in this case here, my guess is we would have been more negative delta than 1.72 if we did that. So this is going to be our position after adjustment. If we go to our next adjustment, it's the 16th of September right now. We go to the 22nd. Again, we take a look at our price chart if you want. We can see we had a break of support here, and on the 22nd we hit a positive delta number again that's high enough to cause us to make an adjustment. So we're going to close these 1820s. We're going to do some playing around in our modeling software, figure out which strikes are relatively neutral delta. And when we do that, we end up rolling back to the 1740 strike level. In this case, in this instance here, we actually end up being a little bit negative delta. Again, we're going to come in and we're going to play with different strikes and see which one's closest to 0. We end up at minus 0.76, and this is our position here. Let's go to the next adjustment. Again, it's the 22nd of September. Our next adjustment is the very next day. We get another 45-point down move. I mean, the market is just, or the Russell here is just really coming down. We're at 2 positive delta again. If you take a look at the price chart, you can see it's pretty much 3 days straight down here. And again, we're positive delta. We're going to do the same thing. We're closing out our 1740s. We're going to look for a strike that is relatively neutral delta. If I do that here, that brings us to minus 1.34 delta. And yeah, we're not gaining a ton of money here, but remember, these are neutral strategies. They generally like to see the market run back and forth a little bit, and generally like to see things in a price range, and this is not a price range. Again, we started way up in here. We're all the way down to 16 almost 1670. So what's that? 230 points or so. So that's a big down move, and we're still doing fine. We're up 1790. Not a big deal, no panic, which is one of the things I love about this strategy. And let's just go forward here. It's the 23rd. It's the 26th on Monday. A little bit positive delta, but not enough to trigger anything. Let's just go to next adjustment here. So it's the 27th. So we do nothing till October 4th. So what happens here is the market kind of consolidates back and forth here. Let's just take a look for a second at the 3rd. So this is what we look like on the 3rd. We are actually under 21 days to expiration now. So remember, we had a profit target of $15,000. That simply isn't going to happen this cycle. The market's it's moving around too much. But we're down to 18 days to expiration. We're up $2,100. Since we're under 21 days to expiration, we're looking for a $5,000 profit number, which can easily happen if the market settles in for a few days here. But obviously that didn't happen here. What ended up happening is on this day here, we ended up getting a 56-point up move, and that was on top of a 48-point up move. So we had a big up move here, then we had a nice gap up here, and now we're going to the upside. And what we do to the upside is we have a series of scale-in points, and we have what we call a reference point, which is our short strikes here, and it's going to be at 1700. We have a scale-in point at 1740. We have a scale-in point at 1760, and then we start having these roll points at 1770, 1780, 1790. What happened is we went from, we exceeded our 1740 roll point. We exceeded, our 1740 add point. We exceeded our 1760 add point, so we're going to add in butterflies here at 1720 and 1740, and then if we had exceeded 1770, we would do what we call a roll, where we remove the 1700 and we would bring it up to 1760. We didn't get that far. We're only at 1765, so we're going to add in 1720 and 1740 iron butterflies here. We are now fully scaled in, and then from here, what we would like to see happen is we'd like to see the market pull back a little bit here and kind of range in the center, and we would gain money very quickly if that were to happen. And in this case, I believe it did. So let's go to the following day. We end up seeing pretty much stays the same, but we didn't exceed our 1770 level here at our checkpoint time. So let's go to the following day. We're down about $8 here. We're up about $21.10 like we were before. Again, we didn't hit any kind of adjustment point. And then on the 7th, we get a 56-point down move in the asset. And that brings us up into the center of our position. It brings our profit and loss up over our $5,000 reduced profit target. So what we're going to do here is we're going to just close this position out and take our money. And I believe the actual profit number ended up being $58.90. So that ended up being an excellent trade, an excellent example of this episode's winning trade, the mighty Bearish Butterfly. If you like that trade and you love the Bearish Butterfly as I do, I encourage you to come on over to lockinyoursuccess.com. That's LOCKE in yoursuccess.com, and check out our Go membership level, where you can follow along with the Bearish Butterfly and 11 other trading strategies as they unfold each week during our Options Trading for Income weekly webinar. Also, make sure to check out thewinningtrade.com. That's thewinningtrade.com, where you can explore past winning trade presentations, receive free bonus material, and find out about upcoming winning trade presentations. And while you're there, make sure you check out our free Trading Performance podcast, where you can learn to skyrocket your trading regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please post that in the comments below, and I will answer your questions for you personally. Thank you for joining me. I look forward to seeing you on the next winning trade.